This is Al Brooks, and today is Friday, November 30th, 2012, and I am recording a blog based upon a couple of interesting things involving the open of bars this week. First of all, here is a day last week, I think it was Wednesday or so, and the market was trending up, but in a channel, and there was reasonable selling pressure along the way. A number of bear bars, reversals, dojis, prominent tails, small bodies. And today we opened up with a bear bar and we raced up quickly for several bars and then reversed and then got a micro double top and reversed down again. A high 2, but a very weak signal bar, especially after such a large bear bar. Chances are we're going to test down more. However, at this point, you have to be suspicious of what's going on. There's a pattern that's unfolding here, and I don't know if you can see it. Yes, 3 pushes up, so you can argue a wedge, and the market should test the bottom of the wedge, this area. We're almost there. However, on a day where the market goes up and then reverses back to the area of the open, especially if it does it fairly sharply, and the range of the day is about half of an average daily range, you have to pay attention and think about the possibility that the day could be a perfect doji day with an open and close of the day somewhere in the middle of the day. So you have to consider that this might be the middle of the day. So if the open of the first bar might be the middle of the day and this is the potential high, you can create a measured move down, and this will be a support area where buyers will come in. Bears will buy back their shorts for a profit. Bulls will buy for a scalp or a swing up. The bulls are buying, expecting the market to test back to the open of the day and for the day to be a large trading range day, especially since the channel up at the end of yesterday had so much two-sided trading. Chances are it'll be followed by a trading range. And then we have big up, big down, big confusion usually results in a trading range. Next slide, you can see how the day unfolded. It came down exactly to the tick, equal to a measured move from the high of the day down to the open of the day, and a weak-looking low 1, a weak-looking low 2, and the bears kept trying to push it down, and they kept finding buyers, and therefore, as trading ranges often do, the market rallied and poked above the top of the range. And then ultimately, later in the day, it came back down to the bottom of the range. Over here, what did it do? It tested the area of the open of the day again, tried to break out again over here and failed, and the market closed near the low. So instead of a small doji bar on the daily chart, the bar ended up with a bear body. Here's the open of the bar, and then the close of the bar is over here. However, the important point is if the open to the high is about half of a day's range and the market reverses sharply, you have to consider the possibility that the day may end up as a doji bar on the daily chart, which means that it could go down to the low of the day equal to a measured move down and then come back to the open as it did here. It broke to the downside again here and came back to the open again here and closed down. I talk about this in the video course and in the books, and this is another example of it. Friday, today, November 30th, 2012, is the last day of the month. When that's the case, I always take a look at the monthly chart before the day opens, and I want to see where the open of the month is relative to the open of the day. Because if the open of the month is close to today's open, the open of the month will be a magnet. So you can see here we're about 5 points away from the open of the month. So before the market opened today, I drew this pink line in because it's a strong magnet. If the market opens reasonably close to this magnet, the market usually 70% chance will test that pink line. By test, I mean probably go 1 tick below, which is what it does more often than not. Maybe 70% chance. It could go more than 1 tick, but usually it goes at least 1 tick below. Traders want to see what's on the other side of support. Will it lead to a breakout, or will it lead to a reversal? We have 3 pushes up, even though it does not have a wedge shape. Effectively, it's a wedge, a 2-bar reversal, but a big tail, and in a relatively tight trading range. Is that a short for a test of the open? It's a swing. I think you could take the short, but I would take it with the plan to get out around the open of the month. Okay, so here's the open of the month, and today's open opened within 5 points of the open of the month. The month has a range of about 50 points, so 5 points is pretty small. And at the moment that this 5-minute bar opened, the monthly chart was pretty much a doji bar, and the monthly bar closed at the end of today. And this is how the day ended. Okay, we came down 1 tick below the open of the month and bounced, tested it exactly here. A higher low major trend reversal, a double bottom bull flag major trend reversal, but only 4 or 5 bars down and no bull bars, so this is suspicious. It may not be strong enough. And then over here we went 1 tick below the double bottom bull flag and formed a perfect double bottom with the spike down here, creating a double bottom major trend reversal. So the bears repeatedly tried to push it below the open of the month. They wanted to have the body on the monthly chart be a strongly bearish bar, or at least a neutral bar. They wanted today's close to be on the pink line or below the pink line. If it's on the pink line, then the monthly bar is a perfect doji, and that's a sign of weakness on the part of the bulls. You know, the market has been trending up, and if now we have a close at the open instead of a bull bar, a close above the open, that means that the bulls are probably getting weaker. So, you know, we tested it repeatedly and we shot up strongly. One other point about this bull breakout here occurred at 11:40, and we were in a trading range day. If a market breaks out after 12:30 or 12:35, I rarely will ever go for a swing. So in other words, I will not buy closes, because most breakouts that occur after 12:40 or later usually do not go far, and this is a perfect example. A great looking bull bar opening on its low, closing on its high. Traders could buy the close, break out to a new high of the day, and then what happened, if their stop was below the bar, even if it was below the 2-bar spike, they got stopped out for a big loss on the final bars of the day, the final bars of the week, the final bars of the month. So I would not be buying closes in a situation like this, because most breakouts that occur that late in the day after 12:40 or 12:40 or later usually do not go very far. And that is all that I have to say today for my blog on Friday, November 13th, 2012. Thank you.